lack of a better word, is good. Greed is right. Greed works.
Hello everyone, and welcome to episode 73 of Let's Play Wall Street Raider. I'm RakeM, your host. Last time out we took another downswing, but we have basically been improving. The GDP growth went all the way down to like a negative 14 and change, and now we're headed back up. The prime rate got up to 13 and a quarter, and now it's headed back down. Our stock index took a tumble, but if the prime rate keeps going down, this should go up fairly quickly, especially if the earnings at our banks are up like they're supposed to be. They're all projected to be increased. So we should see some recovery on our stock index, which is good because we bought some stock index futures last time, and we're long on those. So if this goes up, we'll make some profit there. On our commodities, we don't have any. We don't have any at all. All of them are outside the range. Wheat and corn are starting to look attractive, but they've been so weird, trading in like 2 and 3 month spurts, going up and down, and then staying flat, that they're just not reliable. So if they fall below $4, I'll think about getting them because they spend most of their time above 4. Let's see on wheat, same thing. No, I guess 5. If it falls below 5, we'll do wheat, and if it falls below 4, we'll do corn. But as far as these others, silver has been doing some pretty reliable swings. So if it falls below 14, I guess about 14.50. Let's see what we have on our deal from last time. So last time we had 15, right? So is 15 a good number? I guess so. It goes below it a lot and stays above it a lot. So 15 be fine, and then 18 is what we had. So let's see, 18 would be about there, right? It's getting up there every month. It's not staying for long though, but 15, 18, that's fine. And then on gold, let's see, let's update this. This is $5 and $4, which would make our sale points $7 and $6. So crude, we were buying it at 80 and selling it at 115, but we've had some stuff going on with crude that makes me nervous about buying it that high. I think our new buy price is going to be $60 and sell it at 90. And on gold, we're buying it at 1,000. This is according to my cheat sheet. Buying it at 1,000 and selling it 1,400. But it was way up there not too long ago. We got all the way up to about 1,750. Well, more than that. Got up to about 1,800. So I think what we want to do is we want to buy it at 1,100. 1,100 we want to buy it. And we'll sell at 1450 is fine. That's good enough. So that's what we're going to do. 1,100, 1450. All right, so we bought a whole bunch of bonds, and we could buy some more, but we can only buy a few at a time now. About $1 billion worth at a time is where we're at, because we've bought so many. Look at that, this has already jumped. So we're probably going to hold off buying any more bonds unless the interest rate goes back up again. So I updated my spreadsheet for the first time in 3 episodes, and we had one emergency, absolute emergency that we need to take care of right away. And then we have some secondary priorities on these where they still have subsidiaries that they're passively invested in, and those subsidiaries are losing money now. So we want to sell those off. And then we need to deal with this new stuff that we plan to do to see if we can't create a runaway train and end up with a $6 trillion. But we'll get to that here in just a minute. We'll talk about that when we get there. All right, so the first emergency and the only emergency is Ford. So when we were dealing with this back in episode 71, I think, or maybe 70, GM was going broke, and he had like a 40-something% market share. So we downsized, but it looks like we didn't downsize enough. Right, so we gave Qualcomm a whole bunch of our assets. We gave Nissan a whole bunch of our assets. and it just wasn't enough. We ended up with a monopoly anyway. So what we need to do is we need to find a holding company that we can buy and siphon off these assets. And so what we do is we go to the holding and trading company industry, take a look at the summary. There it is. And we just need to pick somebody out that's not owned or controlled that we can use. And it looks like, let's see, this is auto industry, so let's see. These look good, really. Let's take a look at one of the D-rated ones. Okay, so he's only negative 14 million. We can buy him for 44 and turn him around pretty quick. So let's buy him up. Is he owned at all? Okay, so we'll have to buy that out from Frito-Lay. Not really a problem. Just going to offer 20%. And that was inadequate, which is weird because British Airways is bankrupt. Inadequate. All right, now let's have him buy back his bonds. Does he have a loan? Okay, let's pay the loan off and then buy back the bonds. All right, it won't let me. It won't let me, which is weird. Normally it should. All right, let's just give him some assets. So we need to give him, we have 56%, so we need to give him at least 6%, which would be something like 13% of our assets. Let's leave ourselves some room. So we want to give him probably about 20% of the assets that we hold, which would roughly equate to about 14% of a market share. That is 10%, and if we double it, basically it's 9 billion. Which takes us down to 44.8, which is great, and gives him 11.2%. Okay, so we want him to grow at negative 10. Of course, I guess it doesn't matter. We don't have to sell. We don't have to adjust his settings because we're going to sell him off, right? So let's just have Ford spin it off. Have Toyota sell it. Right? And now it's just a question of whether he's going to make money or lose it. Right now he's losing money. Of course, it's not very much. Not losing very much money. He's already got a bank loan, borrowed 800 million for some reason. Not sure why. Right, but he's positive here, but the industry is deteriorating, so I guess we'll go ahead and sell it off. All right, let's see if I had others. So Qualcomm, he's making money. But the industry is deteriorating. So here's Qualcomm. So it's the same deal here, and he's got an elevated stock price, so let's go ahead and sell that too. We can make a profit on it now. Right? And we've got almost as much cash as we have in business assets. And we have a 7% dividend, and we're bringing in a little over 2% per quarter. So let's increase our dividend to 8%, which would be 65 cents. And see if we can't get rid of some of that excess cash. So now we have 44.8. And we can adjust our colorization. So we still have excess cash, but we've increased the dividend, and we will deal with all of our extraordinary dividends at a later date. Basically, 90% of our companies have excess cash, and we're going to want to disperse it. We don't want to create dividends of higher than 8%. There's no benefit to doing that. In terms of elevating the stock price, all it does is reduces the amount of cash that they have on hand. And right now, because the returns are so bad in the industries, the interest that they're earning on that cash deposit at the bank is actually buoying up their earnings and should help them later on. So when the assets resume making a profit, we can disperse this cash, and those extraordinary dividends will buoy the stock prices of their parent companies. And so we can end up bouncing this stock index much, much higher by doing all these extraordinary dividends all together. And so we're going to hold off doing any extraordinary dividends until we're ready to do them all, basically. All right, so let's move over to Juniper Networks. All right, my notes here are we want to buy NT passively. NT is making a profit now, or will be. He's breaking even now, and the returns are going up. So we're going to buy 19% of him now while his price is low. Okay, and then IE. What does IE mean? I forget. I cannot remember for the life of me what IE is supposed to stand for. So whatever I meant by that, I've forgotten it. I'll just leave it there in case I remember. Because right now I do not. Alright, so let's move on. Let's go to Mitsui. His income's going up and has a ton of excess cash. But he's got money invested in these two companies and they're losing money. So here, Exelon's losing a whole bunch because he still has a swap. And somehow I missed that from last time. See, does he? I think he does. Will it not show me? Let's go to the financial report. It'll show me down the bottom here. Okay, he doesn't have any, but he's losing a whole bunch of money. What's he losing all that money on? Guess it doesn't matter. We're going to sell him off anyway. Alright, and then Puget Power. He's making money. And the industry's improving. So we're going to hang on. We're going to hang on to him. Where is he? He's right here. Okay. So he's done. He still has excess cash, but he took care of that. Took care of that one issue. Okay. Time Warner. He's got excess cash, and there's a company here, Reuters, who is going to be making a profit, and he's really well priced. He's bringing in 3% per quarter, so I want to invest passively in him. Alright, still has excess cash, and we'll deal with that later. Just let's check on his dividend. Let's increase this to 8%, which would be $1.78. And then over to Archer Daniels. And he's going to buy Cadbury, I think, or whoever this is, Conagra. Conagra is making some money, 2% per quarter. So we're going to buy 19% of him. Okay, and he still has excess cash. Okay, not as much as before. He only needs $4 billion. So let's see what his dividend is. 8%, so that's fine. He's bringing in about 5% a year right now. All right, so Sears. He has a company here that's losing money. So we're going to sell it. And as far as his cash goes, again, he's approaching having as much cash as assets, right? But this is just all terrible. So we don't want to do an extraordinary dividend until these returns are up. And that's not going to happen until these guys go broke. And we may end up having to downsize here because these returns are so terrible and we don't have a lot of people with good credit ratings. And this right here is mostly to blame. It's negative 21%. But we're not going to downsize just yet. We're going to hope that, you know, if both of these guys go broke, that's 34% of the market. And we would get half of that roughly. So 17% plus this is 51. And 52 maybe at the most. And that's if they go all the way broke. So we're going to hope that a portion of their assets survive and we don't end up with a monopoly. But if it looks like that's going to change, hopefully we'll catch it before it actually happens. But for right now, we're going to just sit and wait. All right, Boise Cascades next. And it's the same thing with him. He's got these investments. Not all of them are making money. This one's making 1%, just give me 1/10 of 1% per quarter. And you see that the negatives here are not looking that great. So we're going to sell off every one of these and we'll buy them back when these get better. All right, this one we are making a profit on. Let's take a look at him before we sell it off. All right, so he's bringing in a little more than 1% per quarter. This is LPX right here, 7.7%. Decent credit rating. And the industry is deteriorating though, so let's go ahead and sell it. Just take our 25 million profit and be happy. Okay, we've got, again, as much cash as we do assets. Our dividend is almost 6%. Let's make it 8%, which would be $1.16, $1.20? No, $2.20. I think that's right. That's still a shade under, but that's fine. All right, and now Resorts International. Same deal with him. He's got these two companies, and they're losing money. Well, he's not losing money, but... Okay, so we're going to sell off Webb and keep U.S. Homes. Right, we've got a huge dividend, but we have a lot of excess cash. So we're just going to leave it for now. Hope that his stock price goes up, and as his stock price goes up, this percentage will fall. And with our return, hopefully that won't take very long. See, it's already down a percentage point. That is that. Now, we're going to go down and do some stuff with the banks. Because we're not going to disperse their cash, we're going to invest it. So starting with Bank of RakeM. He's got $1 trillion of excess cash. We're going to put that in mortgages. Okay, Mitsui Fire and Marine. He's got $1 trillion. Well, minus this. So 1.2 trillion that he can put in his bank. INGG. He's got 700 minus this, so 568. Aetna has a bunch because we sold off a bunch of his investments. He's got 2 trillion minus this 300, so 1.7. All right, so now let's go to Canadian Imperial. He's got 2.4 trillion, and he only needs 263 billion. So we're going to put $2.1 trillion into mortgages. Okay, Hong Kong, Shanghai. He's got 1.2 trillion, only needs 322. So that would be 900 billion he can put into mortgages. Nordea Bank has 394 billion, only needs 137. So we can put 260. Bank of Tokyo Mitsubishi. He's got $1 trillion, only needs 170, so we can put 830. And then SVB Financial. He's got 1.97 trillion and only needs 100,000. So let's put 1.88 trillion into mortgages. 87 and 84. So that's good. All right. And I don't know if I looked at USVB or USB before in between the two. So he's like way under cash. But we bought all these bonds, and that's where it went. But he doesn't have much in the way of business loan portfolio, so I suppose we can live with that. We're going to build up to this much with all these bonds, especially at these returns. Okay, so that's all the emergencies. Did we look at Juniper? I think we did, but we didn't know what IE meant. What the heck does IE mean? All right, it took me a couple of minutes, but I do remember what IE stands for. Juniper Networks has this huge reserve for contingencies. We're going to turn that into income. I'm going to go to Other, and then Increased Juniper Networks Earnings. And let's do all but 1 billion of it. And that will become earnings in the next quarter. So we can mark that off our list. And now we are ready to try to grow our experiment on these options. So what I'm going to do, we picked up Hazama and we gave him $6 billion. Let's split him. Okay, and what we're going to do is we're going to grab or buy the insurance company that RakeM Bank of RakeM has, along with the other company that he got. I think it was CMGI or something like that. We're going to buy those away from him. Let's see. Let's go to Bank of RakeM and see what those are. Yeah, CMGI and Provident. And I'm going to buy both of those from the bank. Okay, so now Provident's worth 6, call it 7 billion, and Hazama is worth 6 billion, let's say, for a total of 13 billion. So that's about how much CMGI is going to need in order to buy options on 100% of those two companies. So the next thing to do is to give CMGI 13 billion bucks. The next thing we're going to do is we are going to contribute CMGI to Provident and then contribute Provident to Hazama, so that Hazama is the parent and he will own Provident. Provident will then own CMGI. Okay, and now we'll give Provident to Hazama. Bank earnings are declaring, and all the earnings are going to be up, I think. Wow, gold really shot up. And wheat's ready to buy. What we were going to do here? Oh yeah, Hazama. He's got $6 billion, and what we're going to do is we're going to pay off the loan, and then we're going to give Provident $5 billion of it. Let's see, do I want to do that or want to buy the options first? Probably ought to buy the options first. Yeah, let's buy the options first. But let's buy wheat to begin with. All right, so I'm going to have all of the holding companies and me personally buy wheat, and I will be right back. All right, so we got wheat for everybody. Now, let's go back to Hazama. And what we want to do is we want to have him buy options on CMGI. So we need to go to CMGI. And then back to Hazama. Actually, first, we need to have CMGI issue a public stock offering. Right? And we want to end up owning 90% of him. So 1.5 is a 5% issue. 3% would be a 10% issue. But we have to add another 1% because we're going from 100% to 110%. So we've got to go a little bit higher in order to end up with 10%. If we just did 3, we would end up with a 91% market share, and we have to do an extra transaction to get options on 100% of the stock. But at 3.3, we'll own 90%. 10% will be public, and we can buy and sell options on 10% at a time. All right, so now let's go back to Hazama and have him buy call options on CMGI. And we're just going to do 10 transactions until he has options on 100% of CMGI stock. Okay, and I'm not going to round this up or anything. I'm just going to leave it right where it is. I'll fast forward and be right back. So we've bought all of our options, and I notice our stock index is up over 5,000 points, which is nice. So the next thing to do is we want CMGI to buy options on Hazama. So the next thing we want to do is we want Hazama to do a public stock offering. And again, we double this and then add 10%, so we go from 10% to 11, or 10 million to 11, right? And now 10% is public. So we go to CMGI and we'll have him buy options on Hazama. All right, so I'll fast forward while I buy these and I'll be right back. Okay, so CMGI now has options on 100% of Hazama, and Hazama now has options on 100% of CMGI. And the next thing we want to do is we want to have CMGI buy options on Provident. But before we do that, we want to give Provident as much cash as we can. So Hazama has almost 6 billion. Let's pay this loan off. Okay, and so we have 5.5 billion, and Hazama has tax loss carryovers with 800 million. So we basically need to keep, I guess, about 2 billion here. So let's give Provident 3.6 billion. Okay, and now we'll have Provident issue a new stock offering to raise some additional cash and also to make some of our stock public. So we're going to do 11 million shares. Okay, so that gives us almost 8 billion to work with. Of course, we could also sell off subprime if we need more cash. All right, so the next thing is to have CMGI buy options on 100% of Provident. I will do that and be right back. I had hoped to be able to get this done before Provident declared his earnings, but I wasn't quite able to. Got half of them bought, and then the price started shooting up because he declared his earnings, and his earnings are way up. So 1382, and he made 846 just this past quarter. And since his stock price is so high, let's split him. Let's do the same for CMGI. And the same for Hazama while we're at it. Okay, so with this structure, the thing to do at this point is to make sure that Provident Companies has increasing earnings and increasing net worth. So we're going to take our cash and we're going to start making it multiply, basically. And if we do that, the options at CMGI and at Hazama will grow exponentially. So what we want to do here is whatever we can to make this increase, right? So what we have is we have a whole bunch of companies that are D-rated and they have bonds. And if you haven't seen my starting strategies video where I take a whole bunch of negative companies and I turn them around in very short order, this will be new to you. But if you've seen that video, that's exactly what I'm going to do here as well. Right? And the first company that I want to do it with is Lockheed Martin. So I'm not sure where he is on this list, so I'm just going to look him up and buy him and his bonds. So let's buy his bonds first. Okay, there's no publicly traded bonds. So let's go to Lockheed Martin and see who owns his bonds. So his bonds are owned by AIG. So we'll just have to have him buy them back. Right? It's 6.4 billion, but he has over 8 billion in cash. So we'll have Provident buy him and then have Lockheed Martin buy the bonds back. Well, we must have left the bank without some cash. All right, let's sell off 7 trillion in mortgages. Okay, getting back to Lockheed Martin here. So what we've done is we took 4 billion, bought that 6 billion in bonds back, and now our value's gone way up, but our stock price has not changed. Now we could sell this company off for an immediate profit if we just gave him some cash, brought his stock price up, or we could just leave him with Provident and let his return go up, right? And just make money off of him organically as his stock price rises. But he's got a lot of cash, and our other company here, Rolls-Royce Aero, has got a tremendous return and a pretty big market share. So what I want to do is I want to have Lockheed Martin buy assets from Rolls-Royce Aero so that his earnings are even greater than what they are now. Right now they're at 0.5%. If we buy these premium assets, I'm betting his return will go up. So what we're going to do is we're going to have him buy 3 billion worth of assets from Rolls-Royce Aero. So now he's projected to make 3% per quarter, and his return is 18.8% instead of the 0.5. Now I'm going to kill this dividend, or at least lower it down to 1% for right now, and I'm going to leave all the other settings alone as long as he's very capable. All right, we're going to increase the R&D to 8%. Set the dividend to 42 cents. Okay, and that should do it. So our price is already coming up on the strength of that new projection. All right, and we didn't buy this other 2%, but we don't have to. It's better that we don't so that we can sell it off without having to spin it off. And let's see what Provident Companies has to work with now. He's got 10 billion total to work with. And his stock price is heading up. And his return is heading up as well. Right? So if we take a look at CMGI, boom, all these are on the way up. So the trick is to do this a few more times. The next one we're going to do is Cherry Auto. Now he does not have any bonds. He's just underpriced, I believe. Probably should have double checked since we had some transactions to begin with. Okay, so he's selling right at what he's worth. But Honda Motor Company here looks like he's going to go broke. And when he does, the returns here are going to go up. And we'll be able to grow as a result of that. And we can do it one of two ways. We can buy up competitors and take advantage of their assets. Or we can just buy new assets of our own. So as Provident Companies makes money, we can just filter the profits over to Cherry Automobile or to Lockheed Martin, either one, and have them buy assets in their respective industries. Okay, so we have bought these two. Now, let me show you the list. I went through and I grabbed 10 total. Of course, Lockheed was the top one. But these are the next 10 that we're going to do. We're just going to go down the list, starting with ones that we can afford that are under 10 billion. Probably go with Electrolux first. So let's have a look at him. Right, so it's 50 million to buy him, and we can buy these bonds for $1 billion, give them to Electrolux, and increase his value by $2 billion. That combined with with his assets, his price will go, you know, through the roof. We'll make at least $2 billion off of this, which doesn't sound like a lot, but Provident is worth 33, 34, you know, so that's a pretty significant percentage for a single quarter, and we're going to do this over and over. All right, this one we bought 100% because we may have to give him some cash because he has practically none. So the next thing we're going to do is we're going to buy these bonds. Now we'll contribute those bonds to him. All right, now he's trading at his value, and it's nearly $2 billion. Let's see if we want to sell this one or if we want to keep it. So the industry here is not improving and his return is not good. So we'll just sell it off and take our $1 billion profit. Of course, we'll have to do a spin-off, sorry. Let's see, do we have a company we own? Let's give it to Cherry Automobile, and then that way we keep all the profits on this level rather than spin it off. Still 33. Why didn't we go up? We went up a few $100 million here. Oh, I guess it's because the stock price of Cherry Automobile hasn't risen yet. Or maybe it has, I don't know. Gonna make a huge profit, so it should go up. Alright, so that's that one down. Let's move on to the next one. Let's see, let's do Eli Lilly here. Okay, bonds are really low. Pretty cheap to buy. Okay, first let's donate his bonds to him. I think he had more bonds than that. So we'll have to give him the cash to buy the rest of these back, which is going to be about $1 billion. Minus this. So let's give him $700 million. Okay, so we'll buy these back. Well, they're going to make us pay down the loan first. Let's change banks first. Still got 0 credit. Let's give him $3 billion. So we'll need to sell off these mortgages. 12% discount. All right, put the rest of this money toward the loan. All right, now we just have to get the stock price up. And right now we're negative. Right, so what we can do is we can borrow. Whoa. These are going in the wrong direction. We may want to buy some more bonds. And it's time to buy corn. Alright, this may have been a mistake. We may have to give him some more money and have him buy assets from Hoffman LaRoche. But let's interrupt what we're doing and buy corn. Now that it's below $4, I will do that and I will be right back. Alright, so I'm in the middle of buying corn and we get a margin call for Fortis, which doesn't make a lot of sense with the stock index this high. So let's go take a look at him real quick. And see, he's got a bunch. Why are they negative though? The index is up. Why is it negative? I guess because the interest rate rose? Maybe that's what it is? Must be the Contango price dropped. There's no other reason for it to. So let's give him $100 million. Or I mean, $100 billion. Let him ride that out. Alright, so let's go back to, let's see, did Peak buy it? Alright, so let's go to Nick and I'll buy the rest of these and I'll be right back. Alright, let's get back over to Provident. See where we are. Alright, so we're up to 30 billion in stocks. And our value has dropped by 3 billion somehow. So Lockheed Martin here. His price dropped. But his earnings are still up. And the industry is improving, so we're just going to stick with that one. Cherry Automobile, his price is up. And his earnings are more than decent. He's making almost 4% per quarter. And Eli Lilly, oh, that's bad. That is bad. So what are we going to do here? I think we made a mistake by doing this one. Right? The industry is improving, but he's negative right now, and we want profits right now. He's got a AA credit rating. If we borrow, he's going to pay, where is it? 14% to borrow money. I don't think this is updated. Can't possibly lose $1.58. Let's hang on to this one and see what happens. If we have to, we can have Hoffman LaRoche buy it and merge it in. mean, he's got tax loss carryovers too, 15 billion worth. All right, so we've got 3 billion to work with here. Let's go back to our list and see if we can find a good candidate. So our biggest one here is Lockheed Martin. We already did that one. And then this one, which is Good Guys. And for that one, we need 1 billion to buy him, and then 5 billion to get the bonds, which is 6 billion total. Right? And we've got enough for that with credit. So let's do Good Guys. All right, and just to look at Good Guys, he's got 200 million in value, selling for 700. But if we give these to him, he's going to go up by 10 billion. And yet it only cost us 4,600 million to give those to him, or to buy them. 4,700. Right, so now he's worth close to 9 billion. A little over. Right, so this isn't up to date yet. Let's take a look at the industry. Alright, so this industry is in pretty bad shape. So we don't want to hang on to it. We want to just go ahead and sell it off and take our 4 billion in profit. So this one, we're going to give the profit to Eli Lilly, so that, or excuse me, the percentage of him, we're going to give it to Eli Lilly so that he can use that cash to pay down his loan. Let's give him 10%. All right. So we made a little money there, and we're back up to 33 billion. And we just need to do this some more. Now these other ones are a little smaller, but once we get them done, we'll go and look a little further afield. And we need to verify that these companies, or whether or not these companies will make a profit if we hold them. Because I'd like to hold a few and help build up our quarterly earnings. We made 85 cents last quarter, and we're scheduled to make 71 this quarter, but we've got extraordinary earnings which should prop up our net worth. Okay, so let's take a look at Oregon Steel. He's the next one. Right, so we can buy these bonds for about 600 million. And then increase his net worth to positive. We'll have to buy these two guys out though. Looks like he's got enough money to do it himself. Let's see if he can. Actually, no, he can't, because his credit rating is too low. Let's buy the rest. Okay, so he's gone from negative to positive. Let's pay down his loan. Okay, there's Eli Lilly's negative quarter. Now let's go take a look at what his earnings are supposed to be next time. So Oregon Steel's scheduled to lose money. And he's not trading at his full potential. we've got Rio here. Of course, this industry is in bad shape. So we just need to give him a few more dollars, try to get his stock price above 100% of net worth. So let's give him another 500 million. Not quite there. Let's pay down the loan. He's reasonably competent, so if this return was better, I would buy assets from him, but it's not. And the industry is deteriorating. I wonder if we sell him, would we make anything at all? And the answer is no, so I guess we're going to hang on to it. Don't really want to take a loss. Just these are a little closer than I thought. Maybe I should update these numbers now that some time has passed. Our index is still falling, which is not good. All right, I tell you what, I'm going to have to regroup here, update my numbers, and make sure that we don't keep losing money on these because we have on a couple of these. Maybe the numbers were off and I just didn't verify them. So we're going to end the episode here, and I will go do my math and make sure that the numbers are right. And when we come back next time, we will make sure that Provident makes a profit and turns this 32 or 33 billion into something much greater by whatever means necessary. All right. So thank you for joining me. I hope you enjoyed it. If you did, please like and share. And until next time, this is RakeM saying, have a good one.